Okay, so now that we know the steps, we're going to go a little more detail into each one of the steps. Again, I will leave the mechanics for the accompanying video where we walk through one of these models and we talk about each of these steps. So I really want to show you how this is done. Again, this is just the roadmap. Okay, so what you're looking for is that we follow each of these 6 steps. And that's how I'm going to try to tie this. And I'll do my best to remember to tie this when I'm actually working the model in the video. Okay, so let's talk a little bit, just sort of give a little more detail about what we're doing here. Right now, the first step is analyzing historical performance, and actually, the very first step in analyzing historical performance is collecting the historical data. Okay, so I talked a little bit about that already, but this is not a trivial step, and the way that it's presented in these slides, right? Again, that's my fault, of course, but the way it's presented in these slides sort of trivializes it because I don't spend any time here, right? But collecting the data is a time-consuming part of the process, but it's the most important part, and it's one of the easiest places to make a mistake, to make an error. User error, probably the most common thing here. You are typing in, balance sheet, income statement information. You type 10,000 instead of 10 million, and boom, the whole thing goes to shit. Okay, so you got to be really careful collecting all this data, finding all the detail in all the data. We're going to spend a lot of time in the later chapters talking about different points where it is easy to make a mistake because we did not understand the nuance of what was reported in the financial statements. So it's not trivial, but because we spend so much time later in the class talking about it, I am kind of glossing over it here. Okay, so we collect all this historical data, we build consolidated balance sheet and income statement for the firm, and once we've done that, we can start to understand the firm's historical performance. Okay? And of course, the things that we are going to focus on are the things that drive firm value, because that's what we're trying to do, understand firm value. So the first things that we'll look at are, say, the return on invested capital and the growth rate in revenue for the firm. And of course, what is most important for us is to have a benchmark against which to compare these performance measures, these value measures, right? So if you looked at this graph and I didn't have FedEx on here, we wouldn't be able to understand whether UPS having a return on invested capital of probably on average greater than 15% is good or not, right? We could probably objectively understand that 15% ROIC is good, right? Just because we've talked about it in the previous chapter. But we wouldn't know whether it was good relative to its competitors. Maybe FedEx had a return above 20%, and so UPS is really underperforming relative to its closest competitor. In fact, we see the opposite, right? We see that UPS, on a return basis, has outperformed FedEx in the long run over the last 15 years and continues to do so, and not by a small margin. And it's not like the competition is ebbing and flowing, right? FedEx doesn't take the lead, and then UPS takes the lead. It's not a close match. UPS is resoundingly beating them by 7 to 10% in every year in this period. So maybe the alternative is that we've been hired by FedEx and we're McKinsey consultants, and we've been hired by FedEx to try and figure out what the hell is going on. Why can't FedEx compete with UPS more appropriately? FedEx's ROIC is probably averaging 7.5% here. UPS is averaging 15, 16%. They're doing twice as well as we are. What is going on, right? FedEx brings the McKinsey consultant team in. We pull down all this historical data. We start to analyze the trends. We take what we know about ROIC and we start to think about what UPS might be doing differently, what FedEx can do differently. How can managers increase return to generate more value? And then we start running models. The nice part about a model like this is that once it's built, once it's in Excel, we can start to make changes that hopefully flow straight through and update the value. So we can say, okay, what if FedEx makes this change to increase return? Does that do it? Is that going to be enough? Okay, that's not generating enough value. And we can just keep sort of running models and models to keep checking different kinds of assumptions and choices. Okay, but of course we need to be comparing. So what this means ultimately is that we got to do double the work. I gotta have a comparison. I gotta have a ruler to judge, yardstick to judge against, or I'm not doing anything. So with every firm, we've got to find at least one competitor to do this, and of course, more competitors are better. This is why analysts are typically assigned industries so that they can do all of these valuations across the whole industry, and then because they've done that, they then have their comparison group. Now, as we're analyzing historical performance, of course, we're computing return on invested capital. We're computing the growth rate. Those are both coming from NOPLAT and invested capital. ROIC comes from NOPLAT divided by invested capital. Okay. NOPLAT is our reorganization of the income statement, net operating profit less adjusted taxes. And again, I'm going to go into the mechanics in the video, so I won't spend a lot of time here. But this is not. You can look at this statement here. This is not the same as your standard income statement, and there's a couple of reasons why. But the biggest reason is that NOPLAT only should represent the operating profits and costs of the firm, less the operating taxes of the firm. Net operating profit less adjusted taxes. Okay, so we are only including operating items here. That's why this is a reorganized income statement, and not the typical accounting income statement that will have non-operating items on it. Okay, invested capital is the reorganized balance sheet. Again, reorganized so that it only represents operating assets less any operating financing that occurs. Okay, so this is taking the full consolidated income statement and balance sheet, going through, checking to see all the stuff that is only just operating items, reorganizing it so that we come up with these two measures, NOPLAT and invested capital. Because return on invested capital is NOPLAT divided by invested capital. Okay, so the profit divided, the operating profit divided by the operating assets is more or less what ROIC is giving us. Okay, and this again is one of the drivers of value. So we're comparing UPS and FedEx. Now, in step 2, we forecast. So we take all that historical data. So here we just got 3 years, but usually we want like 10 years of historical data. But we got 3 years of historical data. This is going to help us forecast the future. So we'll say, okay, UPS had revenue that actually grew a little bit, maybe grew like 1%, 2% a year. We'll use that to forecast into the future. And we're going to do a forecast of about 10 to 15 years. Right? Depends on the firm, depends on the industry, depends on why we're doing the model. But we are only going to explicitly forecast the firm financials for about 15 years. Right? And in fact, we'll probably do graduated stages, and we'll talk about that a little bit. Okay? But ultimately, remember that historical data is not what we use to determine value. Future data is what we use to determine value. So the forecasted free cash flows that we're going to come up with, or the forecasted financial statements that we'll come up with, we'll use to calculate forecasted free cash flow, and then we'll take the present value and estimate value. Okay. And of course, it would be easier if we just looked at the historical free cash flows, and then drew a trend line and said, okay, free cash flow has been going up by 2% every year. For the last 15 years, if we just assume that happens for the next 15 years or forever, boom, we're done. It's like super easy, right? We don't have to do any more work. And of course, surprise, we wouldn't be in this class if it was that easy. That is not, I hope you can see that that's not an appropriate way to think about the firm. Because of course, the whole reason we're doing one of these models is because we expect changes to occur. Right? So we're not going to forecast free cash flow. Instead, we're going to forecast every item on the income statement and the balance sheet. We're going to forecast them explicitly, each item for maybe 5, 6, 7 years. Then we'll sort of shrink the amount that we forecast. And then by the time we're at the end, we're really only forecasting the key value drivers. So revenue growth, return. By the time the farther out we go, the more our assumptions about the future are going to be wrong. Okay? So early on, right, when we think about predicting the future, Of course, if we are only trying to predict what's going to happen next year, we're much closer to having a good judge of that than if I'm trying to predict what's going to happen 10 years from now, or 15 years from now, or 20 years from now. And of course, even if I'm still just trying to predict what's going to happen next year, I'm probably going to be incredibly wrong. Imagine that we're standing where we are a year ago. Right? Not one of us could have predicted what would be going on right now. And so that means that that's just an indicator of how, even in a relatively short time frame, your ability to predict the future is just crap. Okay? So the more we try to predict the future and the more things that we try to predict, the more assumptions and errors we're going to have to make. So we try to limit that. There's no way to limit it completely. We try to limit it by not making explicit forecasts for every item super quick. Long term, super long term. So we might predict every item on the income statement and balance sheet for 5 years, then only sort of the big items, the bolded stuff, the main groupings for another 5 years. Then we're only going to forecast, say, revenue growth and return for another couple of years. And then finally, we're just going to use the continuing value. Okay? So this works out in our favor in general. Our forecasts for the near term tend to be better than our forecast for the long term. And by the time we get to the long-term forecast, the present value of things that come very far in the future tend to be relatively small. So the impact of errors tends to be less as we forecast farther and farther into the future. And so what we can see if we look at, say, these forecasted revenue growth and return against their historical performance, we see about what we expect from the previous two chapters, namely that return on invested capital is relatively steady, except for a drop in 2008-2009, which is totally expected given the financial crisis, and that revenue growth is all over the place, right? So our assumptions that long-term return about long-term return are going to be pretty good. Our assumptions about long-term revenue growth are going to be mostly a shot in the dark. Now, given that we want to spend at least a couple of years forecasting everything very directly, there has to be something that we want to get out of that. And what we want to get out of that is an understanding of the firm, right? So what we're going to do is we're going to look at the historical performance of the firm, financial statements, for instance, the income statement, and we're going to look at how the income statement has changed over the past 10 years. And what we're trying to let that guide us into doing is coming up with a much better forecast for the future. Okay, so lots of times the things that the company or the management team says are going to be different than the things that they've done, or that or at least they're going to be different from the story that the financial statements will tell about the firm. One of the ways that we can tell is, of course, is trying to look in several different ways at the financial statements that they've filed in the past. Okay, so what we're looking here is something called the operating margin analysis, and this is basically a pictorial form of the income statement, right? Where all of the different costs that affect operating margin are broken down, right? So again, operating margin is profit. So what we're looking at is our operating profit. What we're looking at is all the different pieces that affect our operating profits, all of the different operating costs. And what this helps us better see is the patterns that have emerged over the past 10 years for UPS, right? So we see a few different things, right? First, we see that adjusted EBITDA is relatively stable over the last 10 years, okay? So that's our adjusted operating profit, more or less. We see our other expenses have grown, probably shrunk a little bit. We see depreciation and amortization has stayed relatively steady. We see a pretty large increase in fuel, right? So fuel costs have gotten higher during that period. We see a large increase in what we call purchased transportation. And then we see at least a relatively steady measure for compensation and benefits. Right? So we look at these things, and again, sometimes a picture speaks more than just the financials, just the numbers, because it helps us see trends. And trends are how we're going to predict the future. Right? So one of the big trends that's going to stand out here is that UPS is spending more on fuel and purchase transportation, considerably more than they did 10 years ago. 10 years ago, that was maybe affecting their margin by maybe 10% of their cost. Now it's well over 20% of their cost for these two items, right? So in a period of 10 years, they've roughly doubled. Now, what we would want to understand is, why is this trend going on? How is that going to help us make better predictions about these two things going forward? Should we continue to predict that purchase transportation is getting larger? So should our forecast for 2014, what should it look like based on this margin analysis, right? Well, our adjusted EBITDA is probably about the same, right? Our other expenses, depreciation, probably about the same. Do we assume that fuel and purchase transportation continue to get larger? If that's true, does that mean is that going to eat out of our adjusted EBITDA? Is that potentially going to eat out of our comp and Benny? Where is that coming from, right? So we are looking at these historical data and then forecasting in the future, and we're trying to take these trends and understand why the trends are happening so that we can understand if they should continue or stop. How the firm has been changing will help us understand how it's going to continue to change. Okay. Now, once we have done all that and we've forecasted everything, we've forecasted all 10, 15 years out into the future, we are going to use all of that, those reorganized financial statements, along with NOPLAT, return on invested capital, ROIC, to estimate free cash flow for the firm in the future. All right. Now, again, I can link you to the lectures from the intro if free cash flow is not ringing a bell. We'll talk about it some more, but free cash flow is gross cash flow minus any investment in invested capital. Now, the way that you may have heard this formula in the introduction class is as operating cash flow minus your change in net working capital minus your net capital spending. And that is exactly the same formula that we have here, right? Operating cash flow is our NOPLAT, right? So that is our gross cash flow. Operating cash flow was EBIT plus depreciation minus taxes. So NOPLAT plus depreciation is the same thing as operating cash flow, only here we're calling it gross cash flow, and that's just to be consistent with the book. Okay, so gross cash flow, this is the money the firm has generated via its operations, minus any investments that the firm makes either in its working capital, right? So in its short-term accounts, working capital can include things like building up inventory, that's an investment. It can include like putting cash in a savings account, that's an investment. Or any investment in its fixed capital. So it might make an investment in, say, buying new machinery or equipment or something like that. Whatever's left over from the money that we made minus the money that we invest is free cash flow. And the free cash flows that we forecast for the future are what we're going to use to determine the value of the firm. Okay. Now we're going to forecast free cash flows explicitly, meaning we're going to forecast the financial statements and everything else explicitly for a period of about 10 to 15 years. And then at some point, we're going to say, okay, we just can't keep doing this, mostly because our assumptions about the future are going to be completely wrong 15 years from now. We just have no idea, right? So at some point, we got to stop. And partly it's because there's a good reason to stop, because we don't know. But partly it's because we can't go on forever, right? We're only human. We can't take the present value of an infinite number of free cash flows, and we can't continue to forecast the financial statements out for an infinite number of years. We have to pick a place to stop. And we'll have a lecture where we talk about how to determine that, how long do we actually go, what's the appropriate way to sort of think about this tension between explicitly forecasting the future and then sort of giving up and saying, okay, the future at that point is going to be unknown, and that's where we calculate what we call the continuing value. And so what the continuing value allows us to do is establish a terminal free cash flow, so that we'll have explicitly predicted free cash flows, like 15 of them, and then we'll have a 16th value out there that will have condensed the rest of infinity down into one value. And then we'll only have 16 things to take the present value of, instead of an infinite number of things to take the present value of. Okay? So the continuing value is a mathematical technique that allows us to do this model in any reasonable way. Okay? And the continuing value is what we talked about in chapter 2. This is the key value driver formula. It is establishing the terminal free cash flow for the firm. And once we get to this point where we have stopped making explicit assumptions about the future, we have gotten to a point where we are going to assume the future enters what we call a steady state, or where everything remains the same for the future. So no plat is going to be the same. That means our operating profit is going to be the same forever. The growth rate in cash flows is going to be the same forever. Our return on invested capital is going to be the same forever. Our weighted average cost of capital is going to be the same forever. Right? So at that point, we've stopped predicting the firm is going to change, and we're just going to say, for simplicity and mathematical sake, that the firm will stay that way forever. Now, we know that's not true. It won't happen that way. But it's the only way that we can actually make this model work. So that's what we're going to do. We'll take the explicit cash flows as far as we feel comfortable, the predictions, and then we'll stop making explicit predictions, and we'll just use the continuing value to establish a terminal cash flow, and then we'll have our future cash flows for the firm.